Welcome to the Deep Dive. We're the show that, cuts through the noise to get you the insights that matter.
That's right.
And if you've been following the market lately, well, you've definitely heard the chatter. All this talk about elevated valuations.
Oh, yeah, it's everywhere.
Almost like people think stocks are, finally taking a well-deserved breather after this epic rally we've seen.
A breather or maybe something worse, according to some.
Exactly. So our mission today is to really dive into that, to challenge this idea that, high valuations across the board are unsustainable.
And we're going to use data, actual data, and look at history plus some key macro trends happening right now.
Right, especially this idea of strong capital expenditure, CapEx growth, how that actually supports today's prices.
And it might even suggest a rotation, a shift into specific sectors.
And all these insights, we should mention, they come from Alec Young's piece. High valuations are supported by strong CapEx growth. That was on moneyflows.com, August 11th, 2025.
A really interesting analysis.
Yeah, think of this as your shortcut,
Yeah.
to understand what's really going on beyond the scary headlines and maybe how it impacts your investment thinking.
Okay, so let's jump in. This whole elevated valuations thing, you hear it constantly, right? Especially from let's call them the valuation doomers.
Like the ones who always seem to see a crash coming.
Yeah.
They argue stocks are just way too expensive.
And right there, that's the first point we need to tackle. You can't look at valuation alone in a vacuum.
Okay.
You absolutely have to factor in earnings per share growth, EPS growth. If that growth is there, if it's strong, then a high PE ratio. It's not automatically a sell signal, not at all.
That's a really critical point.
Yeah.
The data tells a different story than just everything's expensive.
Exactly.
And what's really interesting from the source is this idea that stocks being widely overvalued, it's just not really backed up.
Yeah.
The high valuations are actually quite limited.
They're concentrated,
Yeah.
very specific areas.
Like where?
Well, think about the big winners. Those blue chip growth stocks, mostly in cyclical sectors, technology, communications, those guys.
Okay.
You see some pockets in industrials, maybe financials too, but it's mainly those big growth names.
And because they've done so well.
Right. Because they've been so successful, these sectors now make up a huge chunk, like 60% of the S&P 500's total market value.
Wow, 60%.
Yeah. So that's what pushes the overall large cap valuation up to around, say, 22 times forward earnings.
Which sounds high compared to the average.
It does, compared to the long-term average forward PE of about 17. But, and this is key, that 17 average, that was from an era when these tech and comms giants were much, much smaller players in the index. They didn't move the needle as much.
Got it. So the index composition itself has changed the average.
Precisely. And the recent earnings numbers, they really hammer this home.
Yeah, talk about that. Q2 S&P 500 earnings.
Right.
They grew 10%, right? Which was way better than the 5% people expected.
Huge beat. And that's the third quarter in a row of double-digit growth for the index.
But the breakdown is fascinating.
Isn't it? You look at the Mag 7, those biggest tech and growth stocks.
Yeah.
Their profits up an amazing 15.5%.
Okay.
Compare that to the rest, the S&P 493. Their profit growth was just 4.5%.
That's a massive difference. Shows where the heavy lifting is being done.
Absolutely. And it's not just earnings. Overall, S&P 500 sales in Q2 were up a healthy 6%.
Okay.
And net profit margins, they came in at 12.3%. The source calls that tariff-defying. It's strong, and it's actually higher than the 5-year average of 11.8%, according to FactSet.
So the profitability is there, even with those headwinds.
Definitely there, but again, heavily influenced by those leaders. It's also worth pointing out other parts of the market look very different valuation-wise.
Like the equal weight index.
Exactly. The S&P 500 equal weight, the
Yeah.
S&P mid-cap 400, the small-cap 600, they're trading at much lower PE ratios. We're talking 17.7 times, 16.7 times, 15.6 times. Much closer to historical norms.
So expensive isn't the story everywhere.
Not at all. The source suggests this reflects only middling forward earnings visibility for those areas compared to the big growth stocks right now.
Okay, but here's where it gets optimistic, right? The source argues this profit momentum, it might not stay so concentrated.
That's the good news part, yeah.
Yeah.
There are some solid macro reasons to believe that the profit engine could start firing on more cylinders, broadening out beyond just the giants.
Okay, what are those reasons? The source mentions 4 policy tailwinds, I think, for potential rotation into cyclicals.
That's right, 4 key things.
First up, the labor market. Apparently, it's not as weak as some people fear.
Correct. If you look at the 4-week moving average of initial jobless claims, people filing for unemployment for the first time, it's only around 221,000.
And how does that compare historically?
Well, the average since way back in 1967 is 362,000. So 221K is actually pretty strong, suggesting more underlying resilience than you might think from some headlines.
Okay, so a surprisingly robust job market. What's next? Tariffs.
Yeah, tariffs. Remember all the worry back in April?
Vaguely, yeah.
Well, the source says the actual all-in effective tariff rate right now is about 15.2%, which is apparently much better than feared.
Meaning less cost pressure on businesses than expected.
Exactly. Fewer cost pressures, which helps margins across more sectors, not just the ones who can easily absorb it, gives more companies room to breathe, maybe invest.
Makes sense. Then number 3 is stimulus.
Yep, stimulus, both kinds. Monetary policy, the Fed is expected to cut rates, right?
That's the expectation.
And fiscal policy. The source mentions something it calls the One Big Beautiful Bill, suggesting a significant fiscal boost is likely on the way, too.
Okay, so fuel from both the Fed and the government, potentially.
Right, a double dose of support for demand and investment. And the final point is deregulation.
Deregulation. How did that fit in?
Well, the idea is that deregulation is picking up speed. And when that happens, it often makes it easier for companies to do deals, for mergers and acquisitions. M&A activity could ramp up.
And more M&A means more investment.
Often, yes. Companies combine, look for efficiencies, maybe invest in new tech or capabilities. It feeds into that broader investment picture.
Okay, so we have these tailwinds potentially broadening profits.
Yeah.
But how does this link back to corporate investment? To CapEx? That's the core idea, isn't it?
It really is the heart of the argument. And this is where, the bearish folks need to look at history.
What does history show?
It shows we've actually been in a corporate CapEx recovery since the market lows back in 2022.
Really? What's been driving that?
Primarily data centers and the hyperscalers. Think cloud computing, AI infrastructure.
Plumbing of the digital economy.
Exactly. The businesses are spending money, investing in that future capacity. It's been happening.
And what about tax cuts? Do they play a big role here? Is it mainly policy driving this?
That's a great question. Policy is definitely a factor, a tailwind. But the source also points out that businesses are reacting to real opportunities too, like AI demand, the need for more data centers. That's organic.
So it's both.
It's both. But if history is any guide, those corporate tax cuts expected from the One Big Beautiful Bill Act, they strongly suggest this CapEx recovery will continue, maybe even accelerate.
Is there data on that link? Tax cuts and CapEx?
Oh, yeah. Since 1962, whenever corporate taxes have fallen, capital spending has historically increased by an average of 2.5% year over year in the following period.
Okay, that's a pretty clear historical pattern.
It is. So the expectation should be for CapEx to stay healthy, probably get healthier in the coming year.
Right, so companies are spending, investing in the future. How does that connect back to stock prices seeming high now?
The crucial link. This is where it gets really interesting.
Light it on us.
Since 1985, there's been a really strong correlation, a very tight link between rising CapEx and PE multiples expanding, stock valuations going up.
Why? What's the mechanism?
Because markets look ahead, right? They're forward-looking. When companies start spending significantly more on CapEx, it's like a massive vote of confidence.
Confidence in their own future.
Exactly. They're signaling they expect higher growth, higher profits down the road, and the stock market often prices that in before the earnings actually show up.
So stocks look expensive temporarily.
Temporarily, that's the key. They look rich for a bit, but then, as that anticipated earnings growth materializes, the valuations kind of normalize. The E in PE catches up.
Like we saw with Mag 7, maybe. They looked expensive for a while before the earnings really exploded.
That's a perfect example of the dynamic. And here's a killer statistic from the source. When companies are actively increasing their investment, their CapEx, equity valuations climb 81% of the time.
81%. That's pretty compelling.
It's a very strong historical tendency. Hard to argue with that kind of data.
Okay, so if we connect all these dots, CapEx rising, potentially broadening profit growth, what does this actually mean for building a portfolio, for investment strategy?
Well, it suggests that maybe those widespread fears about overvaluation aren't the biggest thing to worry about right now. The bigger story might be this investment cycle.
And the source has a clear message about which sectors benefit most, right? The cyclical message.
Very clear. History shows cyclicals consistently do better during these CapEx recoveries.
How much better?
Looking at the 12 months after CapEx increases, cyclical sectors have typically outperformed the overall S&P 500 by about 0.8%.
Okay. And what about defensive sectors?
They tend to lag. Same period, defensive sectors have historically underperformed the S&P 500 by about 2.4%.
So a clear divergence based on this CapEx factor.
Definitely. It's not just theory, it's what tends to happen when companies open their wallets and invest.
So what's the actionable advice then, based on this analysis?
The advice is pretty direct. Look to buy the dips in those cyclical areas that benefit from investment and growth.
Specifically.
Tech, communications, financials, industrials, and the source even includes AI-related utilities, which is interesting. These are the sectors historically supported by these CapEx cycles.
Then what should investors avoid?
The advice is to resist the urge to bottom fish, basically, trying to buy stocks that have fallen hard in the defensive areas.
Like staples.
Healthcare. Exactly. Staples, healthcare, energy. They just tend to underperform when CapEx is the main driver. It's not their time, according to this view.
And the source, moneyflows.com, they seem pretty confident about this call.
They do. They actually make a point of saying their analysis got it right on the valuation story when maybe other research firms were more negative, and they're sticking with their recommendation to buy the dip in the right places.
Okay, so wrapping this deep dive up, what's the main thing you, our listener, should take away from all this?
I think the core message is don't let the headline fear about elevated valuations completely cloud your judgment.
Right. You need to look deeper.
Yes, look at the crucial data points like this powerful signal from rising corporate investment, the CapEx story, and those macro tailwinds we talked about.
It's really about understanding where the growth is now, but maybe more importantly, where the investment suggests growth is headed.
Absolutely. It's a reminder, isn't it? To always look beyond the surface metrics, understand the drivers, the context, the history. It encourages a more informed view.
Definitely.
So maybe we can leave you with a provocative thought to mull over.
Okay, let's hear it.
Given the strong link we've discussed between CapEx today and earnings tomorrow, what new industries or maybe unexpected areas might be next? Where could we see a big surge in capital investment in the coming years? Could that lead to their own sort of Mag 7 style valuation expansion, even if we don't typically think of them as growth sectors right now?
That's a great question to ponder. Where's the next wave of major investment going? Something to think about.